$84 billion, gone in 4 months. That's how much capital fled Canada in 2025. Foreign investors pulled out $17 billion. Canadians moved $27 billion into foreign assets, a double exodus. This isn't a blip, it's a trend. And if you're a Canadian investor, this data directly impacts your portfolio returns. Here's what's happening and what you need to do about it. Let's put this in perspective. In the second quarter of 2025 alone, foreign investors withdrew a net $17 billion from Canadian markets. But it gets worse. Canadian investors themselves moved $27 billion into foreign securities, same quarter. So you have foreign capital leaving and domestic capital fleeing. That's not a vote of confidence. That's a market screaming a message. To understand how unprecedented this is, compare it to 2007, right before the global financial crisis. Capital outflows hit $66 billion. Now we're at $84 billion in just 4 months. We've blown past crisis levels. And here's what makes this even more concerning. In 2007, the outflows were triggered by a global credit crisis. Banks were collapsing. The entire financial system was under stress. But in 2025, we don't have a global crisis. The U.S. market is hitting record highs. European markets are recovering. Asia is growing. This is specifically about Canada. The money isn't fleeing a global meltdown, it's fleeing Canada. The question every investor is asking, what's driving this exodus? If you want daily breakdowns of economic data that impacts Canadian portfolios, hit subscribe now. We decode the numbers so you don't have to. Where is all this capital flowing? Primarily south, way south. In May 2025 alone, Canadians bought $7.3 billion in U.S. equities. Add another $2.5 billion in U.S. bonds. But it's not just America. Canadian investors are moving into European markets, Asian equities, and emerging market funds. The pattern is clear. They're diversifying away from Canadian assets. And when we look at which sectors are seeing the biggest outflows, the data tells a stark story. Canadian energy stocks, despite sitting on massive resource reserves, saw net outflows of $4.2 billion in the second quarter. Technology companies listed on the TSX lost $2.8 billion in foreign investment. Even Canadian banks, historically the safest bet in our market, saw $1.9 billion leave. This isn't retail investors shuffling RRSPs. This is institutional money, pension funds, asset managers. The smart money is repositioning globally, and they're doing it fast. Take the Canada Pension Plan Investment Board. They now hold 67% of their assets outside Canada. That's up from 55% just 5 years ago. The Ontario Teachers' Pension Plan increased international holdings to 72%. These are the most sophisticated investors in the country, and they're voting with their capital. $14 billion in foreign stocks purchased in a single month. That's almost as much as Canadians invested abroad during the entire 2009 financial crisis. Let that sink in. So what's driving this capital flight? 4 main factors. First, policy uncertainty. Tax changes, energy regulations, shifting trade policy. Investors hate uncertainty. When the rules keep changing, capital looks for safer, more predictable jurisdictions. The capital gains inclusion rate jumped to 66.7% in June 2024. That's a massive tax increase on investment returns. Then there's the uncertainty around carbon taxes, which directly impacts energy sector profitability. Add in proposed digital services taxes, potential wealth taxes, and ongoing debates about foreign ownership restrictions. Every policy shift creates another reason for capital to question whether Canada is the right place to be. Second, Canada's productivity crisis. We're operating at just 70% of U.S. productivity per worker, according to OECD data. Lower productivity means lower profits. Lower profits mean lower returns, and investors notice. This productivity gap isn't new, but it's widening. In 2015, Canada was at 75% of U.S. productivity. We've lost ground. That 5 percentage point decline translates to billions in lost economic output and lower corporate earnings. When companies can't compete on productivity, they can't deliver the returns investors demand. And third, currency weakness. The Canadian dollar is down 8% against the US dollar in 2025. When your currency slides, foreign investors face currency risk on top of market risk. That makes Canadian assets less attractive. A foreign investor buying Canadian stocks faces a double hit. Even if the stock price stays flat, they lose 8% on the currency conversion. That's a massive headwind. And Canadian investors face the opposite calculation. By moving money to U.S. assets, they gain an automatic 8% currency boost before any market returns. And fourth, the brain drain. 350,000 skilled Canadians relocated to the United States between 2020 and 2025. When talent leaves, capital follows. It's that simple. These aren't random job seekers. These are engineers, doctors, software developers, data scientists, the exact talent that drives high-growth companies and innovation. When they leave for higher salaries in the United States, they take their skills, their networks, and eventually their capital. And the companies they would have built in Canada get built in Seattle or San Francisco instead. These four factors create a compounding effect. Policy uncertainty reduces investment. That lowers productivity, which weakens the currency, which accelerates the brain drain. It's a negative feedback loop. But here's the paradox that makes this so strange. Despite $84 billion in capital outflows, Canada still ranks second in the entire G20 for doing business. Second, only the United States ranks higher, according to the Business Council of Canada. How do you reconcile that? Well, business rankings measure structural factors: rule of law, political stability, educated workforce. Canada scores extremely well on those metrics. We have strong institutions, low corruption, excellent infrastructure, and a highly educated population. On paper, we're an ideal place to invest. But rankings don't capture real-time market sentiment. They don't reflect policy uncertainty, productivity gaps, or currency risk. They measure what should work, not what is working. And right now, the gap between theory and practice has never been wider. So Canada exists in two realities simultaneously. On paper, it's one of the best places in the world to invest. In practice, capital is fleeing. That disconnect tells you everything you need to know about the gap between perception and reality. What does this mean for Canadian investors? 3 direct impacts. First, currency pressure. If capital keeps leaving, the Canadian dollar weakens further. That makes imports more expensive. From groceries to electronics, you pay more. That's inflation through the back door. When the dollar drops another 5%, your imported car costs 5% more. Your vacation to Europe costs 5% more. And your iPhone costs 5% more. And when you factor in that 40% of goods Canadians buy are imported, a weak currency hits your wallet hard and fast. Second, slower job creation. Businesses need capital to expand and hire. When investment dries up, job growth stalls, wage growth slows, economic momentum dies. We're already seeing this. Canadian job growth averaged 1.2% in the first half of 2025, down from 2.4% in 2023. Wage growth slowed to 2.8%, barely above inflation. When companies can't access capital, they freeze hiring. When they freeze hiring, workers lose leverage to negotiate raises. The entire economy slows. And third, portfolio risk. If you're heavily weighted toward Canadian assets, you're swimming against the current. The institutional money is moving out. You need to ask yourself if you're holding Canadian stocks and bonds out of strategy or out of inertia. The average Canadian investor holds 70% of their portfolio in domestic assets. That's home bias. And right now, home bias is costing you returns. While the TSX gained 6% in the first half of 2025, the S&P 500 gained 18%. That 12 percentage point gap is the cost of staying home. The data suggests one clear action: diversify, reduce home bias, increase international exposure. Don't put all your capital in a market where $84 billion just walked out the door. So that's the capital flight story. $84 billion gone, foreign investors out, Canadian investors out, currency falling, productivity lagging. If you want to understand where capital is moving and how to position your portfolio accordingly, subscribe to Maple Money Data. We track the flows so you can make smarter decisions. Keep your capital smart and your wealth growing.